Welcome back to the channel, everybody. I'm Jay from Investonomics, and welcome to another lecture this week. This week we're talking about portable alpha. This is a bit of a more complex topic. It talks about the alpha component and beta component of a portfolio, alpha being the excess return and beta being the risk of the market. And I'll explain a little bit how these play a role, but essentially PIMCO is a company that has figured out a way to split these two. And in order to do that, they utilize derivatives and other securities, and they are able to replicate a portfolio that actually outperforms the market by using these derivatives. Very interesting topic, very cool, a little bit more portfolio management style, but it's a very interesting topic, a little bit more complex, but we break it down so you understand it easily. So I hope you enjoy this one, and I'll catch you guys next time. Hi everyone, welcome back, and today we're talking about portable alpha. And this may sound interesting to some of you, and it really is. So this week's topic is a little bit more complex and relates to an area of finance known as portfolio management. And this can also actually fall under the category of economics. What is portable alpha? That is the big question. Portable alpha is a portfolio management technique that was first developed by PIMCO, which is also known as the Pacific Investment Management Company, in the early 1980s. And it was built on the backbone of the capital asset pricing model, or the CAPM, and it served to generate very respectable returns for investors, as any portfolio manager would be aiming for. The idea is to decouple the idea of alpha of a portfolio of stocks from its beta component. And don't worry, we're going to discuss what each of these is in turn. So the aim of the strategy is to provide investors with a more efficient way to consistently outperform a market index fund. And this may sound too good to be true, but you'll see in a minute how it works. It decreases risk by separating the more risky alpha portion from the stable market beta investments. Portable alpha strategies are very flexible and can be effortlessly tailored for risk tolerance, the type of securities they are exposed to, and the level of return that the investor desires. They're also currently used in various pension funds all over the world. So what are those Greek letters? Let's start with that. It's very important. So to fully understand portable alpha, we must know what both alpha and beta represent in this context when discussing this portfolio theory concept. One of our first videos was regarding the idea of modern portfolio theory with Markowitz, which explained roughly what beta is in this context. The alpha component of a portfolio is referred to commonly as the excess return an investment makes, and this is over and above the market return. So it's the excess return over the market. So for example, this can be something like the S&P 500. Now if the S&P returns 10% in a given year, and a different investment that has an excess return has 13%, this excess return, or alpha, comes out to 3%, since that is over and above the market. So now on the other end of the spectrum we have beta, which actually measures the risk of investments using the market as a benchmark. In the portable alpha framework, beta is termed to the market index investment. Since beta actually measures the market risk level, beta for the market is benchmarked at 1.0. For the purpose of portable alpha, beta is the return yielded by the overall market, and this is what it's colloquially used as. So this is the return on the market. So as an example here, if we have an investment that has a beta of 1.3, this then means that it is 30% more volatile or risky than the market is. So if the market rises by 10% in a given year, we expect this investment to rise by 13% over that same period, given this excess risk. PIMCO discovered that when utilizing derivatives, and mainly in their case futures contracts, and various other securities, they can actually decouple alpha from beta to create a significant excess return above the market for sustained periods of time, and this has stood the test of time as well. So now a very important part of this is the reliability of alpha and beta components that we choose for the portfolio. So for this to work, we need to have a clear and easy way to actually separate the components effectively. We need also very reliable sources from which we obtain both alpha and beta. In the case of alpha, an investment vehicle that manages for us, in our case it's something like a hedge fund, but alternatively can also be taken into the portfolio manager's hands and we can actively manage ourselves in-house. Alpha is typically generated through active trading, and this makes sense because we're trying to get those excess returns over the market. In order to achieve a relatively reliable alpha, we need 4 very important components in this kind of investment. So first, we need stable returns throughout the business cycle, so regardless of whether it's a bull or bear market. We need outperformance of cash and savings accounts of this alpha return. We need lower correlation of risk component or beta of the market, so we don't want too much correlation with the market, and we want low volatility, so it's not too risky. Alex Shaw of GAM argues that a fund of hedge funds, which is essentially an index fund of hedge funds, and takes the management of many hedge funds and pools them together, is the most effective way to generate a consistent alpha for the portable alpha strategy. This is the case because hedge funds actively aim to reduce risk overall and their market correlation, and their goal is to achieve excess returns or alpha. So this aligns the goals of portable alpha and hedge funds. The beta component is less important since there are many reliable market index funds these days, so it's easier to find a good one, most of which actually boast very cheap MERs or management expense ratios. Now a great example of this is the ticker SPY, which perfectly, with very low tracking error, mirrors the S&P 500 index. And this is exactly what we want to mimic the market. Beta measures, like SPY, should facilitate low tracking error and low fees, as we've discussed, in order to reduce the adverse effects that these costs have on the alpha component, because every cost we incur takes away from the potential returns. So now let's talk about how there is a reduction in capital outlay through this method. To truly advocate the efficiency of the portable alpha strategy, PIMCO utilizes S&P 500 index futures contracts to have the same exposure overall to the market, but using much less capital to do so. This excess capital that's then freed up by using derivatives is allocated to the alpha portion of the portfolio, in which the managers actively trade US Treasury or T-bills in PIMCO's case, with the excess capital that we made free. So in their specific case, the S&P futures make up the portfolio's beta, which is the market, and the actively traded treasury securities make up the alpha component of the portfolio. So here's an example from CME Group, which is a fantastic resource if you guys want to learn some more about portable alpha, among many other things. So if we have $120,000 to construct a portfolio, instead of buying index funds for $120,000 and replicating the market, we could instead buy S&P E-mini futures contracts on the S&P index. This is very common to replicate the market. The excess funds, if we get $120,000 in notional value of futures contract, will run us about $5,000, and this is the beauty of the leverage of derivatives. So the extra $115,000 can then be used to yield excess returns or alpha by actively trading those treasury securities. Now this is exactly the purpose of the portable alpha strategy. They utilize derivatives to reduce the cost of funds, and then using the leftover funds to generate excess returns. So we're earning that market beta while we're actually generating alpha using the excess funds. So combined, we have beta returns as well as alpha, meaning we are actively outperforming the market, and this is the beauty of it. So when we're generating both alpha and beta simultaneously, and utilizing the wonder of leverage from the futures contracts that is utilized here, this allows a portfolio to be created through porting alpha, and this is where it gets its name. We take alpha and we port it to be used against beta. And this efficiently and consistently offers returns greater than those offered from just the market. So see you guys next week.